I think traditional financial planning is really failing us. The struggle, the anxiety, that's real. There was a popular survey done by an insurance company that suggested that people are more scared to run out of money than they are to die.
What a horrible way to live your life. And I'm thinking, man, what did I do wrong?
You have to understand that getting to retirement is not the same thing as getting through retirement, mostly because we're holding on to old financial planning techniques. This is the limiting factor. The 4% rule is what really keeps people on edge.
It's funny that it's so easy to be like, annuities are dumb, life insurance is dumb. And
it's a slog. We know after research that people with pensions live longer, whether that's less anxiety or more to look forward to. We just know that people have guaranteed income sources tend to live longer.
These insurance companies are the most stable and will be the last institutions to fall. Walter Young, welcome to the BetterWealth podcast.
Thank you. Appreciate it, Caleb. Pleasure to be here.
I'm excited for you to be on here for a couple of reasons. Number one, congrats on the incredible book. My hope is that whether you are a financial professional, an advisor, or someone that's just literally interested in how to better your financial life, they can check it out. What I'm excited is we're going to be talking about life insurance. We're going to be talking about retirement planning. We're going to talk about what you call the fifth option. We've had a lot of videos where we talk about in theories. You actually put together a presentation just for our audience that shows data, that shows actually how some of these strategies work. And I could not be more excited because I've heard about you from a couple people. Hutch, our friend, put you in touch with me. I'm super grateful for him, and I'm super grateful for this conversation. And I told you, our audience is kind of weird. They like seeing numbers. They like seeing like actually how strategies work. And so excited to chat with you, but I'm also excited to dive into your computer and look at some real life strategies.
Yeah, that's great. And what I've done is taken some of the math out of my book. There's a lot more math in the book, but we took a little bit of excerpts here just to use as examples.
Amazing. So before we jump in, no one comes out of the womb being like, I want to talk about retirement planning and I'm going to write a book on the fifth option. So like, what, in your quick nutshell, how did you stumble upon this? Why are you passionate about helping people with their money?
Yeah, a couple of things. One is when I went to MBA school, I was doing so out of having to work with a small business that I was working on to actually help them with their accounting and finance and just kind of get them up and running. And so literally every night I would go to school, learn a lesson, bring it back to the business and try to deploy it. And then I realized also I could just do that at my house. And so I began to kind of develop this theory of how corporate finance and personal finance really are almost the same in terms of how they function. So that kind of got me on the steps of learning more about cash flow solutions and income centric solutions. But then also, I just have this giant passion for what I call the mere mortals of America, the people who are in that kind of middle to upper middle class that are really struggling to figure out how retirement's going to work, that don't really understand how retirement math works. And they're hanging in the balance right now, right? The wealthy people always get the great advisors and and all the techniques, and they're really just trying to preserve their wealth, pay the least amount of taxes, pass their money on to the next generations. But most of America is sitting in the balance. And I think these strategies will be the difference between having the retirement they really deserve and not. And quite frankly, I just feel like it's just, it's almost a mission to get this information that's coming from, the academic world that doesn't hit the average person. And so, the book really is a way of taking some of this academic theory and turning it into a story that I hope is much more approachable for a lot of folks.
Yeah. I had the opportunity of speaking to a group of pretty successful investors that were 60 and 70, age range. And I spoke about what I talk about is the and asset. I know that you're familiar with the message. And a lot of them came up to me and said, I wish I would have known about this when I was younger. And man, I need to tell my kids about this and all this. And I'm thinking, man, what did I do wrong? Like this could help you now. And some people ask me, they're like, hey, this is my situation. I got this type of portfolio and am I too old? And what I said is it all comes down to efficiency and optimization. What are you currently doing? And can using certain products, in this case, whole life insurance, can that better your scenario? Can that better your future cash flow? Can that create more certainty? Is it bettering your scenario? And if that's the case, you should do it. If it's not, you shouldn't. But what's interesting to me is when we hear life insurance, even the way that I explain it a lot of times, it's funny that it's so easy to be like, I'm going to discount that. I'm going to discount that. Here's my challenge to all of you that are watching or listening. You might be young, and what Walter's going to break down is so important because whether you talk about infinite banking or using your whole life insurance policy to do certain things, know that all the things that he talks about, give you options in the future, which is amazing. You're going to talk about the fifth option. Love that naming around that. But you might be 60, 70, or maybe even 80 years old. And I'm not saying that this is going to be for you. I'm just saying that some of the things that Walter is going to be talking about are universal and could potentially help you better your financial situation. So Walter, if there's anything else you want to say to set the stage, I would love to know why you wrote this book. But I also would love to dive in because I saw a sneak peek of some of the things that we're going to talk about, and I can tell you it's going to resonate.
Yeah, I appreciate you asking. So yeah, really the book was really meant for me because I haven't done much marketing around it to really crystallize my message and in a way to really take the works like Dr. Wade Pfau and some of the folks that are pioneering the way retirement income planning is being discovered. We know retirement income or income planning is really a relatively new field, right? Because generations past didn't need it. And we'll talk about the presentation a little bit about why that was the case. But, I think, when we read some of these academic journals or papers, it's hard. And the average person, the average advisor, quite frankly, doesn't take the time to really digest it well. And so he paid me the compliment, actually, saying, that some of these stories are actually better than his because it's really meant for, public consumption, really meant for the layperson that doesn't understand finance. To, we're trying to just create a story, a journey of these people discovering how retirement income might go and what their choices are. And we're really trying to tell people that there are multiple choices to the way you retire. And I love how you focused on efficiencies because efficiency is everything in terms of how retirement will go. We could have good asset bases or bad asset bases, but the efficiency of which we turn that into income is what matters. And part of where I look for that inspiration really is the corporate world too, right? The corporate world is full of making sure that every dollar is efficiently deployed, because people lose jobs if they don't, right? And so if we had that same rigor, quite frankly, if we had shareholders that were watching our every moves, we probably would handle our money a lot better. Yeah. And so the idea is just to bring efficiency. And the last comment really is, people won't be able to save as much money as they might need to, if we're using just kind of the old traditional retirement rules. And so efficiency allows people with smaller asset bases to still have a reasonable income that they can retire with, right? And that's the goal behind the book.
I love it. All right, with that, man, let's jump in.
All right, so the fifth option is the name of the book that we talked about. And so let's just dive into it. So I always like to start with this story, which sometimes feels silly, but I think it's a good entry point, which was, imagine for a second you discovered something so powerful that even mentioning it out loud meant risking your life. That something that you came up with was going to change the path of humanity for the future. What would you do? And such was the case with an astronomer, mathematician in 1543. And we know that this gentleman had a decision to make. And legend has it that Copernicus, on his deathbed, finally gave up the manual to his students that proved that the Earth revolved around the sun and not the opposite. Now, for some of the people out there, this might sound very disappointing, very anticlimactic, right? Well, this is obviously an evidence of truth. And so the question is, well, what does it have to do with financial planning? And quite frankly, absolutely nothing, except for one thing, which is we understand that conventional wisdom is a powerful detriment to progress. And the reason I bring that up is that even though Copernicus had proved this in 1543, it took another 100 years before traditional or the conventional wisdom in the land finally said that, in fact, the Earth revolved around the sun. And the reason I bring this up here is that I think financial planning is in a similar situation, which is we have all this new evidence, all this new proof that there are better ways of thinking about retirement income planning, and yet we're still mired in this old traditional path. And so to some degree, I kind of feel like we are the Copernicus of our business, which is we are bringing these new truths, hoping to open the eyes and open the industries and people to better ways to handle their retirement income planning. In a large degree, I think traditional financial planning is really failing us. And we can see that by just the ill preparedness of a lot of folks out there, the struggle, the anxiety that's real. And I think that is mostly because we're holding on to old financial planning techniques that may not be working as well for us today. So my goal for most of my clients and the folks I work with is to help navigate the modern economic environment. We're in a different place now. And I think our finances has to evolve to match the economic environments that we're in. And for most of us, we have to understand that getting to retirement is not the same thing as getting through retirement. Just because you're at the retirement age, you are just at the second stage of life. And we have to make sure that all the monies and the choices you've made financially prior to is sufficient to go as long as you need it to go into the future. So my goal is to provide a structure that we can follow that will at least give us choices in the future. You're not here to say that one choice is better than another, but I want people to choose how they're going to retire on purpose, not as a default plan. And hopefully that will give us the feeling of some of this financial freedom. I kind of joke with clients, there's a big difference between sending your grandkids Christmas cards versus visiting them. And my goal is to make sure that they're on a plane every Christmas. So today, if you're okay with it, Caleb, what I'd like to do is just go through a quick thing, a couple of options that we may go through, which is first, just real quick, some of the challenges that today's retirees face, a little bit of history. I love history, and I think it gives us a context to where we are today. And then some of the latest research that's relating to retirement income planning, if that's all right with you.
Absolutely.
So when we get to the core of this, whether I'm doing presentations with a couple or maybe a group of folks, I always ask the question, what are the biggest fears that we think about when it comes to the retirement? Caleb, what do you think some of the answers, when you probably ask this question too, what are some of the answers that you think are common? What comes up in your thinking?
What's usually common when I ask that question is it all stems from running out of money. So it could talk about, you could talk about volatility, you could talk about increasing in taxes, inflation, but it really comes down to running out of money or not being able to pass on the type of money to your kids or estate that you're hoping for. But the first one's a lot more painful because you don't, like, the thought of running out of money is just a thought that I think paralyzes people.
That's the one risk we can't have happen, right? And so you're absolutely right. When I do group seminars, inflation, taxes, healthcare, market crashes, but ultimately we get to the conversation of running out of money. But here's the thing. None of these are the biggest risk. None of these are the biggest risk. The biggest risk is longevity. Understanding how long you might live is the biggest risk we face, because if I live a short period of time, Caleb, how impactful was inflation?
Not very impactful.
How impactful is taxes?
Not not very impactful unless it's in a high tax season.
Unless you're already in tax. But the point is, the longer I live, the more all of those become important. And so it's the longevity, it's the unknown of how long I'm going to live is what creates this anxiety around retirement. In fact, there was a popular survey done by an insurance company that suggested that people are more scared to run out of money than they are to die.
Wow.
Which I thought was a really powerful finding. And I wonder if that was the same even just a generation ago. See, what we don't know is, how long are we going to live? And the longer we live, of course, the more money it's required to support us through that long retirement that we all hope to have. And so this is kind of the modern retirement quandary, isn't it? We're trying to figure out this newfound longevity that we have to face, and how do we begin to navigate the idea that retirements can be 20, 30, 40 years into the future with a finite amount of money that when we come at retirement with, right? So a brief history lesson. At the turn of the 20th century, the very notion of retirement really did not exist, right? You typically, life expectancy wasn't that long. We began to break away from the apprentice master class kind of idea where people would grow up and learn a trade from some master of the trade into the Industrial Revolution. And as people left those trades, they became part of the industrialized mechanism that America was beginning to build. And so we know that for the most part, people worked until they died, or they worked until they couldn't work, or they became a ward of the state or lived with their families. That was really what retirement was all about. And then slowly something interesting happened, which was in the late 1800s, American Express came up with the very first private pension. And interestingly, this pension, the point of the pension was to attract good talents, no different than a lot of pensions are today. Even back in 1875, they were looking for good workers. But one of the things that came out of this was that the pension allowed a separation of service where someone could leave with some sort of dignity into some unknown retirement period of time. But the dirty little secret, of course, we know, is that very few people live long past retirement.
But they did it to recruit people long term. Like they're like, hey, come work for us the rest of your life till you quote unquote retire. And because you dedicated your life to this, we're going to give you a pension. But the life expectancy didn't last much longer after that. And so for the business, they got lifetime employment and the pension dried up when the person died.
That's exactly right. Right. So good advertising about the pension, and a good way to attract and retain people. If you work with HR today, right, what are they always worried about? Attracting, retaining good
Yeah.
employees. Right. So nothing's changed in the last 100 and some years. So 1875, we see the beginning, the shift in mentality of being able to separate people at certain ages so that they can bring in new talent to create the value in their companies. So that began what we know as the first leg of the retirement stool. We all know then later on in the 1930s, the second leg of Social Security came about. Most of us understand that maybe the history behind that is actually German, right? And so we borrowed this model from Germany to be able to put a Social Security net underneath us for people that live long. But Caleb, as you know, people at that age still weren't living that long into the future. And so
Wasn't
Social
the life
Security,
expectancy like 2 years
yeah,
after?
that's exactly right. So Social Security was one of these things where if you lived an abnormally long time, there was a social netting for you. But the average person was not expected to draw very much from that, right?
Yeah.
And so that was, leg one, leg two. And then, of course, the third leg of the stool is just what you could save. And so from the 1930s really into the 1990s, we saw this prolific growth in pensions. And mostly that was due to the fact that the government gave it some tax cuts that when the pensions first came out, they were very seldom used. But as soon as it became a tax deduction, they just blew up, right? And so now we have this wonderful relationship that if you worked a while for a company, and you retired at 65 and you paid off your mortgage and you got your gold watch and you had a mortgage burning party, that you could sunset into retirement with a pension and Social Security that really did pay the majority of your life expectancy or life expenses for a period of time into life expectancy. And so that really was the golden age of retirement, was when we had all these tools working for us. But as we know now, things are different, right? We know pension plans are all going away. Social Security has a lot of ifs about it. And savings for some folks is a hard thing to do. So in a really weird way, Caleb, today we're a lot more like those folks in the 1900s than we might even be like our grandparents.
When you
The
say
one
Social Security,
exception.
because that's the one thing I'd push back. I don't talk to very many people that have pensions at all. Some people that
Yeah.
do, it's like they're golden. And obviously, if you look at the way people are saving today, a lot of people don't have that. But Social Security, do you just feel like the future? Is that what you're talking about? Or because
Social
I
Security
believe
has to be
everyone that
dealt
has Social
with.
Security now is going to continue to get it.
Yeah, I don't think Social Security is going away, but I think it's going to have to be dealt with, right? And
Yeah, I
so
agree.
it could be that future generations, Social Security maybe starts at 70. I think Canada is actually experimenting with later and
Yeah.
later ages for their Social Security. Maybe we have to cut back on how much you get. We know right now that, in the 20,000 30s, the Social Security is, if we don't do something with it, that it's about a 75% payout. So there's something that's going to have to be changed, right? Maybe it gets taxed more. So it won't be the
Yep.
same Social Security that maybe our grandparents had.
And
But I'm
I
with you. I don't think
I'm
it's
going to
going
self
away.
promote here. If you want to know more about this, I actually have an episode that I did with Ken Kies, who believes he could have solved Social Security back in the Clinton days and talks about the whole story. And so if you want to know more about that, it's a phenomenal interview. You can check out the link down below. But yeah, Social Security is something that is a very interesting topic. And unfortunately, both sides don't want to address it because they're trying to buy votes.
Yeah,
And
exactly.
it's kind of interesting. So yeah,
It's
I understand what you're saying. Yep.
Yeah, and so my point is that today's the youth today really are back in that same position in the 1900s of not having a lot of the same benefits that their prior generations did, with one big difference, which is we're living just a whole heck of a lot longer.
Yep.
And so that really creates this conundrum, right? So leading financial scholars agree that your retirement will not go the way you think it will, right? And so we look at some of the old time experts, right? These are the folks that created modern portfolio theory. They're the ones that really where a lot of money management is based around their findings. And when we go back and see some of their later interviews, they're recognizing that the way they project how their money is managed has the advantage of always viewing money management over the long run, right? Over long periods of history. But they're all agree and all have comments to some degree that the challenge is when you're retiring is that you don't have the long run anymore. And that taking money out of portfolios is very challenging. I think it was Bill Sharp that said retirement income planning is one of the sneakiest and nastiest financial problems to figure out. And so we understand that we're now kind of getting into this new realm of that, we have to kind of change a paradigm in how we think about retirement income planning. And we have some of the newer folks, right, that are taking up the mantle who are really talking about how retirement income planning for modern folks, the people without the pensions are going to go. And so a lot of the work that I've done is really based on some of these, the giants of the industry and some of the research that they've really put forth. And so my own little personal bias having an MBA and having worked at a large international consulting company for, in helping companies, optimize their scenarios, is that there's corporate finance and there's personal finance. And even though they share the same word finance, they manifest themselves in totally different manners. And what I mean by that is corporate finance is always based around profits and cash flow and the money movement and returns back to shareholders. Go on to CNBC, you rarely see a CFO ever brag about their balance sheet, right? It's always about earnings. It's always about cash flow and the efficiency of which they handle money. Personal finance, unfortunately, really manifests itself around balance sheets. Most of the advisors out there really talk about how much money do you have and how much money can you save, right? It's a different paradigm. We have cash flow on one side of the equation and balance sheets on the other side of the equation. But here's the problem. You cannot take your 401k statement to any grocery store and buy milk with it. I don't care if it's worth $1 million, you can't do that, right? You must turn your balance sheet into cash flow. And the efficiency of which you do that will determine how your retirement is going to go. Now, don't get me wrong, a big balance sheet is always a good thing to have. But a smaller balance sheet might actually outproduce a bigger balance sheet based on the cash flow strategies that you deploy, right? When I remember having a conversation with the president of a major life insurance company, Caleb, one that you work with. He's now retired, but I had a glass of wine with him and I asked him, what is the element that you're most proud about when it comes to your insurance company? And now this was one of these kind of big, kind of football, kind of imposing people. And he wasn't used to someone challenging him on his ideas. And he very proudly told me, it's my balance sheet, right? We have an incredible balance sheet. We're renowned for our balance sheet in the industry, and that's what we're proud of. And of course, it was very impressive. But I took a risk, Caleb, and I asked him, I told him, I don't think that's really the most important thing about your business. And he looked at me like, what are you talking about? And I asked him, well, what do you have to do every 2 weeks for your employees? Well, I got to pay them. And what do you have to do when there's death claims? I got to pay them out. And what do you do every year with your policies? Well, we pay them dividends. And so even though that night we didn't come to a common ground, the very next morning he sent me an email saying, Walter, my balance sheet is impressive, but if what you mean is cash flow, I have to agree that is the most important thing. And it made me realize that as someone at that level, you still kind of was stuck on a balance sheet approach and not a cash flow approach, that we really needed to educate people about a cash flow approach, a cash flow centric way of thinking about retirement. So I just kind of coined this term that if you have a balance sheet only approach, you have a BS retirement. And that's just the idea, is that we got to get past thinking about balance sheets and more into cash flow thinking, right? A balance sheet is just the beginning of the retirement income solutions and strategies.
Yeah, here, let me just break this down. I love what you're saying, and so often people care about net worth. Even people care about like their growth rate in their portfolio, but that really results in net worth. But what you're saying is cash flow is the thing that we should care more about. We should call retirement planning actually future cash flow planning. And like using the cow example, it's like, would you rather have a bigger cow or smaller cow if you cared about milk? Well, if you're thinking it's like the bigger cow is going to produce more milk, then maybe the bigger cow. But if the smaller cow produced more milk or just as much milk as a bigger cow but ate less, these are kind of the things that are like it gets you start thinking about what is the actual outcome that we're trying to go for. And I love the BS balance sheet. I think that's a very interesting way of explaining it, and I will definitely be using it in the future.
Yeah, for sure. Net worth to me is it's like beach mussels, right? They're fun to look at, but they're not necessarily that useful, right? I need to make sure that what it is I have can be turned into cash flow efficiently, and I need strategies to do that because it doesn't just happen, right? And I think the idea behind this is to understand the different ways that we can do that. Someone could have two people could have $1 million, but if one's earning 40,000 in retirement, the other one's earning 70. Well, the 70 person wins, right? Yep, and think of your assets as just frozen cash flow, right? It's just cash flow waiting to be unlocked. And so we just need to figure out what are the best ways to do that. So I could have safe, predictable, and plentiful income into my retirement, right?
That's really good.
Sometimes I'll just kind of joke with folks and say, well, which would you rather have, 11.5% returns or 13% returns? And of course, everyone says, I want the 13% return. So I just kind of, put up this chart, and let me explain this chart, and let me put a giant caution on this. Whenever we look at numbers, we have to understand that there's just as many numbers where things work and don't work. I'm using this just as an illustrative point to be able to make, to show to kind of make a point here, which is here is a scenario where in 1995, for the next handful of years, the market averaged about 11.89%. And if I had $1 million starting balance, you can see a $100,000 withdrawal, which is enormously large, and we would never suggest a 10% withdrawal rate. But here it is, it actually worked. And in fact, he had plenty of money left over. But then if we change a different period of time, we get to this 13%, right? Here we have a period of time where the market averaged 13%, and I'm out of money. And so the idea behind this is to begin to teach people that the average that we earn, the bragging rights that our portfolio averages some large number over someone else's smaller number, is meaningless, right? What we really care about, or what we should be very cautious about, is how is that average calculated? We all probably intuitively know that there's negatives up front, we're going to be in trouble. There's negatives in the back. We may have plenty of money left over. But the problem is you will never know what your sequence is going to be until the end. And then it's too late to know how did you do. Right? So we want to begin to just kind of pose this problem where it's not the average rate of return on the portfolio that matters. It's the sequence of what you earn that matters, right? And so I kind of joke with people that if I have one bucket of 0-degree water and one bucket of 200-degree water, and I put a foot in each bucket, on average, I should be comfortable, but I really have 2 unhappy feet, don't I?
That's a good analogy.
So we know that averages can be a very misleading figure when it comes to thinking about retirement, okay? So one of the things that we talk about is kind of understanding when we go to, and this is really the crux of the book, is that when we go to our financial planning advisors, traditional planning advisors, and they do all the machinations and they say, all right, you're going to have a certain income for retirement and it's well below what you thought, then they give you these 4 frustrating choices of how to improve your outcome. The first is you can save more money. Well, we know that that's always a challenge, but here's the other part about saving more money, is that you now are stealing current lifestyle from a potential future lifestyle, right? And we know that there's 2 lifestyles that are always at war with each other. And so we might be conservative by saving more so that we have enough for the future lifestyle, but we might look back over the course of time and have some regrets of things that we didn't do just because we had to try to save more money. The second is to take more risk, right? Well, most of my clients that get in closer to retirement age are not excited about taking more risk, right? Trying to get more rates of return and try to grow our balance sheet, because it's a balance sheet approach, try to grow our balance sheet to become a bigger number is taking more risk. The third is working longer, right? A lot of people bring this one up, say, I'll just work to 65 or 70. But we have to remember that your body doesn't always let you do that, and nor does your job. Mm-hmm. So it's a dangerous thing to plan that you will forever be able to work as long as you want to work. I think more than half of people that retire do so not on their own volition, but just because of an illness or maybe a downsize. And sadly, the fourth option is the capitulation. This is what really breaks my heart the most, which is once you've had all these wonderful conversations of what people want to do in retirement, and they see, the lack of income that's really being projected, then they talk about living on less. And this is where people start telling me, well, we don't need to travel, or we don't need to go to dinner, or we don't need to go see our families, right? They start taking away lifestyle. And so these are the 4 frustrating options that most people are given when they think about traditional financial planning.
Yeah. And let me just speak to that real quick. If you can just go back, saving more. Obviously, that's something that there's an opportunity cost to every one of these things. So obviously, if you can save more through efficiency, I know our friend Dom Blanton in Circle of Wealth, I think he's really, really big on if you can find wealth transfers that you're already losing, obviously saving more could be huge. And there's no doubt that any one of these can help your financial model. So if you save more, you're going to actually have a better outcome. But other than taking more risk, because the definition of risk is your chance of loss. And only in America, we think increase your chance of loss and you're going to be better off. You might be, or you might be worse off. But working longer is something that's I'm a fan of love what you do. I think life is way too short to not love what you do, but that's not a great option especially since a lot of people are forced in retirement. And then living on less, that's welcome to America. I think that's where a majority of people are at, is they're just going to live on a fraction, and then they're going to let inflation really erode at that already small amount. And that's the situation that we're in. So I just wanted to speak to that, but I believe, drum roll please, we're getting to the 5th option.
Yeah, I think, and so, but what if there was A fifth option, right? Which is the name of the book.
And if it's a shock to you that there's a fifth option, you might want to unsubscribe. But if with all joking aside, it's funny. 80% of the people that watch our content don't subscribe to the channel. So subscribing, commenting, and sharing really, really help this message get out. And obviously, Walter, I'm going to encourage everyone to take time out of their day to get your book, because reviews and all help this message get out. But also, if they subscribe to this video, it does. So yeah, drum roll, please.
Yep,
Fifth option. Can't wait.
Yeah. And so before we get there, I want to show you actually, I want to show you the 4 frustrating options in action, right? So one of the things I like to do with folks is I go to this Vanguard nest egg calculator. And it is essentially a Monte Carlo simulation tool where we take hundreds of thousands of market returns and piece them all together to see how well will a certain scenario work, right? So let's assume we have a normal 30-year retirement. And let's say just for easy numbers, we'll say we have $100,000, $1 million in retirement. And let's assume that someone can earn 8% in the markets. And most people will tell me if I earn 8% in the markets, then perhaps I can take out 6% because of 2% profit. So we can see our parameters here is 30 years, $1 million. And what I want to know is how many times, what percent of the time does $60,000 from this scenario work? And so now we'll set our portfolio. Maybe we'll just go back to the old 60-40 portfolio that a lot of us grew up with and just say, okay, we have a 60% stock portfolio, a 40% bond portfolio. And now I'm going to run a simulation. And this simulation is 100,000 simulations of this scenario. And we can see that it's just better than a coin flip that we'll have any dollars left over after retirement.
Wow.
So now what do we have to do to make this better? One of the questions I'll ask people is, what percent chance of failure are you okay with? It's amazing, Caleb, how many times people have to sit there and think about what that should be. And I have to let them know that no failure is absolutely okay, right? And the minute they're given permission to think that way, then they want a 95% chance of success, right? Not the traditional 80% chance that a lot of traditional financial planning is okay with. We can do better than that, right? So, but here, I want you to see that Vanguard is telling you the same kind of ideas, which is, all right, the first thing I can do is save more money. All right, well, let's just see how much more money do I have to save? And just time for brevity, I will just show you kind of what probably that answer is, right? So I have to save another $700,000. Let me tell you, if it was hard to save $1 million, there's probably very little chance you can almost double that when you get there. And so that's what it would take for me to get to that 95% level, right? So they're saving more money. Always a possibility, but very challenging.
Yeah, so there's still a 5% chance that you could fail this, but you're saying, hey, these are some black swan events. There's a really good chance if you got 1.7 million, you could probably take out $60,000 a year. And so
correct.
I'm just,
right. So that's save more, right? So then let's talk about working longer, right? Let's just have a lower, a less retirement. Let's just go back 10 years. Let's say instead of having 65, we're going to have 10 years less of retirement. So here we go. So working didn't get us there.
It's crazy,
right? So I can't outwork. I can't work long enough really to make this scenario work. So then let's go to our next one, which is, well, we took more risk, right? What if we had more stock in our portfolio? It should be better that way, right? Well, what if we had 100% stock, right? You can't get any more risk, can't get any riskier than that. And we see that barely move the needle. In fact, we know that's we got to have this. We got to have a little bit of. Let's just try 70-30 or maybe 80-20 just for the heck of it, right? And that'll probably actually do better, right? Or it's about the same here.
Oh, wow.
So our portfolio structure really isn't going to save the day either. So what's left? Well, sadly, this has to change, doesn't it? So 60,000 isn't going to happen. Well, what about 50,000? Let's take a not just a 10%, $10,000 pay cut, but a significant percentage pay cut. And we can see that it doesn't happen, right? So where do I have to go?
I got to significantly. It's got to be like 335.
Right, probably.
And that's the other thing. When we start looking at inflation, that's not much money now. Like, what's the buying power going to be on that? It's pretty depressing.
Right. So Vanguard, I think, really has this tool to caution people that when you're taking a market-only approach to retirement, that this little cheat sheet down here, the 3.6, is the withdrawal rate.
Yep.
So Vanguard is
So,
saying if you want a 95% chance, you got to be in that 3.5% withdrawal rate range, which for most people means they just physically can't save enough to make this
yep. Yep.
work. Right? So I want people to see that it's not just me or some of the experts talking about it. It's on some of the public and popular tools too. What Vanguard can't tell us is the solution, right? Because they don't offer it.
Yep.
They don't offer the fifth option, right? So let's go back to
Yeah, that's
our
really good. I appreciate you taking time to break that down, because that's something that, again, we verbalize, but you showed us not using your calculator that you designed, but using Vanguard, which is Vanguard Nest Egg calculator, which anyone can access, tons of credibility, and they're just looking at data.
mm-hmm.
And so I love that.
Yeah. And so I do that because I think Vanguard's kind of like Switzerland, right? People will believe that that's the
And
case, but
and there's people like Dave Ramsey that says you can get an 8% withdrawal
yeah,
rate in
yeah,
perpetuity. It's like,
yeah.
let's run that, Dave, and let's see how
Not a
that.
lot of
Yeah,
academic support for that one, is there?
yeah,
Yeah. So the idea is that the real default plan for most people is the 4% rule, and we don't have to go into the history of it, but just know that it was tested over rolling 30-year periods from 1926 to 1956 and 57 to 27 to 57 and such. And what they were searching for was what was the highest withdrawal rate where I kept $1 after 30 years, and 4% was the place where it failed under one of those 30-year periods. Now, I want to make sure we're clear that lots of times you could take out more than 4%, right?
yep,
It's not saying that it just means that we're guarding against the one outcome in case you got unlucky and that was your outcome,
yep,
right? So we know
yep,
that 4% works under most of the times. And certainly if you want to roll the dice, you could take out money at higher rates. But I think the consequence of running out of money is so large, we need to be cautious that
yep,
never actually happens, right? So the chart that really came from it, here's an Ibbotson chart, which many people may have seen, which just shows us kind of how, as we go further and further into retirement, that bottom axis, that
yep,
our success rates get very small, right? And
yep,
unfortunately, so many people think that if they earn an 8% return in the markets, they can take out 6% because there's a profit. And that false thinking is actually what started Bengen in the whole process, right? Was
yep,
understanding that it's the sequence of returns that matter, not the gross rate of return. And so this is the limiting factor, right? The 4% rule is what really keeps people on edge, because not only is there still anxiety around how little the income is, but there's still really consumer behavior around what happens when markets do go down, right? How many people do we know
yep,
that have plenty of money but won't spend it just because they're worried, right?
yep,
And so there's a mental capacity to this as much as an academic capacity. And so, one of my favorite quotes, we've all seen the
yep,
compounding, which is fine, but one of my favorite ones really is that Einstein once said, insanity is doing the same thing over and over and expecting a different result. And I think this absolutely means there's a financial insanity as well, where we're all doing the same kind of planning and wondering why no one's working, why it's not working for folks. And so I think we have to change the paradigm entirely. So one of the parts, the stories in the book that we're most proud about is this thing called the desert island dilemma. And every retiree must answer this dilemma. And the dilemma goes like this. Imagine you found yourself washed ashore on a desert island. And as you look to the shoreline, you see this floating barrel. And you go down to retrieve the barrel. You open up the barrel, and you can smell the sweet smell of fresh water. And you pull the barrel up onto the island, and then a thought hits you. Is this all the water I have to drink? And in order to answer that question, you start to have a second question, which is, if this is all the water I have to drink, well, how much can I drink each day? Well, to answer that question, Caleb, I would like to know two things, wouldn't I? First, I'd like to know how long am I going to be on this island for?
yeah,
Well, I can't know that. When I look around, I don't see any ships. I don't see any planes. I might be on this island for a while.
yeah,
And the second question I want to know is, will it ever rain?
yeah.
Well, when I
That's
look up in the sky, I see blazing sun. It may not rain for a long time. So, Caleb, if you don't know how long you're going to be on the island and you don't know if it'll ever rain, how much water should you drink each day?
not as little as possible.
As little as possible, right? Because I have to make this last as long as I
Yeah,
need to,
makes
and
sense.
I want to be rescued. But now let's change the scenery. Instead of being on a desert island, let's just say you are now in your office celebrating your last day of work. And your boss gives you the same barrel, but instead of a barrel of water, it's a barrel of money. And as you're driving home, you recognize this is all the money I have to live on for the rest of my life. Then we have the same issue, don't we? How much money can I spend each day? Well, Caleb, I would like to know two things, wouldn't I? One is, how long am I going to live?
Yeah.
Can't know that. And we'd like to know, what rate of return will my money earn? I can't know that either. So, Caleb, if I don't know how long I'm going to live, and I don't know how well my money will earn, how much money can I spend each day?
As little as you can get by with.
Yeah, and so that is the anxiety behind
Yep.
retirement income planning, is that we
Yep.
can't answer those two fundamental questions. Nobody
Yep.
can.
Yep.
But luckily for us, there's an industry that can, and that is the insurance industry, right? The insurance industry has developed actuarial science that we can take advantage of that will help take the risk away of living too long, or and taking away the risk of the markets, the volatility of the market. So I'm just going to share a couple of high level strategies. You can get such more detail in the book
Yep.
of 5 strategies that involve actuarial science, right? And actuarial science is so critical that, I think what's happening is we're going to see a resurgence and a recombination of investments in actuarial science to recreate kind of that pension feeling that we once had, that
Yep.
allowed generations to retire at higher standard of livings. Please note on the left, the safe withdrawal rate is the default plan. You get that by doing
Yep.
nothing, right?
Yep.
But we have to take action. We have to take active steps in order to deviate from that 3.5% that we saw in Vanguard to do better, right? So the first one I call beat the bear, which is, this is for someone who is very comfortable with markets and may want the markets to be a large part of their overall retirement. There are plenty of folks that are okay with that risk. And so one of the things I want people to understand is that when we see an average return, right, we say, like, if you can average 13.5% over a long period of time, would you be comfortable taking out 10%, right? I mean, we've already given away a little bit of this answer, but for people who are seeing this for the first time, they nod their head because there should be a profit at the
That
end of
makes
the day.
sense. Yeah.
Right. And when I take out my 10%, I actually have money left over, right? And now I'm probably their kid's best friend. But when I
Yep.
ask people what's wrong with this column or what's wrong with this chart, it takes them a while for them to really understand that yield is the same number. And
Yep.
when we think about a lot of financial planning tools or calculators, isn't that how it works? You put in a rate of return that you think you're
Yep.
going to get, and it holds that rate of return as a linear constant throughout your years. And so it gives you a certain answer. But we know that if we're not careful, and we take a look at that return column here, which is the actual returns,
Yep.
taking out that $100,000 could mean I run out of money very quickly. Now,
Yep.
I want to make sure that we put a big caveat here, that this is just one sequence of return. There's plenty of sequences where it would have worked or would have been much
Totally.
better. But I want to point out that, of course, we can find periods of time where these don't work. And the point is, the more we do, what if I started in 1972 or 73 or 74? What
Yeah.
we're really doing is creating Monte Carlo, aren't we?
That's
And
right.
so, but we don't live a Monte Carlo in retirement. You will have a specific sequence. It won't be a Monte
Yep.
Carlo sequence because you don't have every option possible. You will have one defined sequence that you won't know what it is till the end. But the
Yep.
point of this is that if we have negative years up front, there's going to be pressure on your income going forward. So how do we
Yep.
solve this? Well, we can certainly solve it by having some non-correlated money that is available to us that we can access when markets are negative. Now, in this particular chart, you'll notice I have at the very far end $75,000. Why is it not $100,000? Well, because I'm deploying the cash value of life insurance as that non-correlated asset to use during those negative years. And because it's a life insurance policy, I'm not taxed on the income. Therefore, I won't need quite as much to satisfy the $100,000 income, right, that we had before. Now, this doesn't mean I'll get through every scenario, but what it will mean is that I will extend my capital longer than if I didn't have this asset. And in fact, you could actually, people always tell me, well, for me to have this cash value, man, I didn't have it invested. And we can show plenty of models where you may have a few dollars less than if you just put that money in the markets, but you still will have less income. Let's go back to our BS scenario, right? Having more money does not necessarily mean more income. It's the efficiency of which we put these two together that's going to allow us to have that income. So maybe you need 4 or 5, or maybe 6. The more of the buffer asset we have, the more aggressive I can be with
Yep.
my withdrawal rate, because the 4% rule is there because it's assuming you will have to get through
Yep.
negative markets. But if I don't have to take money out during negative markets, I can start to take money out at 5 and 6% at the same level of risk as 3 and 4, right?
Right.
So this is one way that we can really navigate the positives and negatives of the markets. Now, let me put a side note. There's lots of times you might want to have volatility buffering. I had 3 kids go through college. During that 12-year period of time, markets were up and down all the time. And so the last thing I wanted to do was pull from retirement or the education funds when the markets were negative. So I
Yep.
used my life insurance policy for that. And by doing that, I actually extended the
Yep.
length that those funds had, enjoying the up years that allowed the money to grow so well, but making sure that I wasn't participating in the negative
Yeah.
years, right? It doesn't have to
The
be
concept of volatility buffer is brilliant
yeah.
because you can, if you believe that the market is the place for your money to go because of long-term compounding and the upside, make sure that you play it through and don't kill the goose slaying the golden egg. And you just showed something that blew up, and then you take 3 years out of that, and now you have
Mm-hmm.
over $1 million, and it
Mm-hmm.
doesn't blow up. It's
Right.
just wild to me, and I think it's just it's a good example. We've been saying lots about volatility buffers. There's lots of different examples. You putting numbers to this is very helpful.
Yeah. And again, it's different times in the markets, have different results. But here's a very extreme one where 1972 is always used as one of the worst times to retire because there's some negative years up front.
Yeah,
And so if we just don't participate in those years, we don't get that same drop in our account balance, right? Some people call it dollar cost ravaging, right? When we take money out
yeah,
during
that's
negative
good.
years,
Yeah,
right? And so we just don't want to, let's don't play by the rules, right? I just think, traditional advisors just tell us to just kind of get through it or just live on less or,
yep,
readjust balances between stocks and bonds. But the reality is bonds didn't do that great in the last handful of years either. And I
yep,
think, when we think about life insurance, and we won't get to this today, but there's so many other benefits that come with life
totally.
insurance besides this, that it becomes a
Well, and
no-brainer as one of the tools for that, as a buffer tool.
that's one of the things, and whether we talk about this now or maybe that's why you should subscribe to this channel, is life insurance. Yeah, you could use your money in a high yield savings account. You could put your money in a bank, which you would still get the volatility buffer. I want everyone to know that. And maybe I'm just stealing your thunder, but like life insurance has so many other benefits. If you actually understand all those benefits, it's so much more valuable to store your money in a life insurance policy than in a high yield savings account or a CD. And I sorry if I stole your thunder away, but like it's just important that people get that.
Yeah, no, yeah, I think the most important thing, like you said, is you can like life insurance for so many different things, and the good news is you get them all.
Yeah.
Right. And so, so it's a very versatile product that when as you get more advanced with how it works, you'll see more and more places that it can be part of a financial strategy.
Yeah.
So that was beat the bear. So now we move to the second kind of strategy, which is really just a generic bucketing strategy. And the idea here is that this is really meant for someone who has a little bit of tolerance for markets, but gets nervous when markets are negative. And so what we're doing here is just segmenting dollars into time frames. And when we segment dollars into time frames, we can choose the best products for that time period. Most of our clients come to us with a single portfolio. They have big retirement accounts, and they're kind of a 60-40 or 70-30 blend, and that's it, right? We're going to navigate how to take money out of a blended portfolio. Well, that's one bucket basically, right? But now we think about dividing that bucket into its time periods. We can use a very simple model, which is we have money in our now bucket. Sorry for this, clever nomenclature, but now bucket really just means that first year where we want our first year's income. We want any kind of emergency or comfort fund, right? People like to have a certain amount of money that's available to them. And then any planned expenses, maybe it's a trip, maybe it's a new roof on the house or a new car, whatever you're doing at retirement. We want that in very safe and liquid form. Then this soon bucket is where we will take the income for the next 9 years, right? So we have 10 years of income in front of us that was visible to us. And the idea is that this is a little bit more conservative because this is where we want to really negate those drops in the market in the first handful of years. We know that any drops in the first 5, 6, 7 years of retirement have an overwhelming disproportionate effect on your retirement than if they happen later on. So by having potentially, for example, an annuity here or some sort of conservative investment, we can really literally take away the market volatility in this period of time. which allows us then to put our growth assets into a time period more suitable for
Right.
retirement, which is the longer run, right? And we can't say the long run because when we get older, we don't have the long run, but it's longer term than that
Yep.
first period of retirement. And then, of course, some of the legacy and long-term care stuff, so we can see like the death benefit might be part of this later bucket, but the cash value could be part of the soon or the now
Yep.
bucket, couldn't it? Right? We could actually divide life insurance as kind of parts and
Yeah.
put them in these buckets as well. This is a perfect place for people who still are comfortable with markets, but really want to eliminate the disaster that could happen the first handful of years out of retirement.
Right. And it's common in this type of strategy to utilize life insurance and potentially annuities
That's right.
in the mix
Annuities could be
with.
part of the spoon bucket here because they have
Yep.
all the upside, but none of the negative downside, right? So I can
Right.
just take a portion out each year. And now
Love it.
I've pretty much given myself guardrails for 10 years. And then the
Yep.
idea is that if markets continue like they've always continued, then, about 10 years, you're about doubling what's in this later bucket. Then you can go ahead and buy another 10 years of income, right? We're kind of just building
Yep.
bridges of 10 years, right? Is what we're really
Love
doing.
it.
And that way
Yeah,
we
no,
don't, we don't have
this is
near
a
the
powerful
volatility.
strategy that we use, and I'm sure lots of other people that you've trained and worked with use. And it's fun because we don't know exactly what the future holds, but like we're building the different buckets that give us all kinds of opportunities, and
Yeah.
love this example.
Yep, exactly right. So the last one I call Pension 2.0, and it's really based on Pension Max, the old Pension Max days, where if you remember, maybe if you're young, your father had this or your mother had this, where when they got done with their jobs, they were given this pension and they had to choose a pension. And we know that the highest pension payout was a life only payment, meaning it lasted as long as the person that worked at the company. And we know that most people did not choose that payout because if they died the very next day, they basically disinherited their surviving spouse. And so lots of times they would choose a lesser payout in order to protect their spouse. But the idea behind pension maximizations and pensions in general is that we know that if we're part of a large pool, right? Let's say we retire at age 65, and let's just say life expectancy is 83. We know that for any couple we talk to, yes, their life expectancy might be 83, but they could certainly be the folks that live to 100. So
Right.
this is life potential, which is different than life expectancy. If we don't use actuarial science, then we have to plan for life potential, don't we?
Yep.
Right? I can't have them plan to be broke at age 83 because they might live longer.
And
But
what a horrible way to live your life. Like
and
saying, like,
yeah,
speaking
exactly.
that into existence. I don't want to get all wishy-washy, but it's like, don't speak that over your life. Don't say I'm
Yeah.
going to die at 83, because you probably will. Like, because our brains are powerful and the subconscious is powerful. So I want, this is data, but there's power in the words and what you're speaking of your life. And
Mhm.
unfortunately, being afraid to run out of money is almost creating an incentive for you to die, so you don't have to do that, which is really messed up as I speak that out loud.
Yeah. And I'll tell you the opposite is true, that people with pensions live longer. Like we know
Right.
after research that people have pensions do live longer, whether that's less anxiety or more to look forward to. We just know that people have guaranteed income sources tend to live longer. And so the idea behind this pension 2.0 is simple, which is if we can join a pool of people, thousands of people, right? Tens of thousands of people, hundreds of thousands of people, like the insurance companies can do, then they can take on the risk of the average life of age 83. And we know that if you live beyond age 83, they still have to make their payments to you. And the reason they can do that is because some of the people will die before age 83. So
Yeah.
if I'm one of the lucky ones that lives beyond life expectancy, I am subsidized by the people that died before. And so we can't have that kind of payout system when we just do it as a couple or as
Yeah.
a family of one or two. And that's called mortality credits. And it's extremely powerful in terms of how much we can pay out. Imagine at 65, I don't know what my retirement, how long I'm going to live, but I do know that even if I die early, I will have gotten larger payouts from the insurance company than I would have done on my own, simply because they're taking on that risk. And if I live a long time, then of course I had a lifetime of larger payments and I'm better off for that still. So let's take a look at this in action. When we think about pension, there's only 4 outcomes that can happen with a pension, right? And we don't have a crystal ball, but let's pretend like we
Right.
did. let's pretend that we know that, that we're going to be that we're going to live a long life, right? Well, the four options are the person who worked, you could live a long time, outlive your
Right.
spouse, right? If I'm the person that outlived my spouse, which pension option would I wanted to choose? Well, the life only, right? Because that was the
Yeah,
highest
the life
one,
only. Yep.
right?
Yep.
Well, now what if my spouse outlives me? Well, now I would be happy to have chosen the smaller amount so that my spouse isn't
It
disinherited.
depends. It depends. If is they outliving you by a year?
Well, that's true. Let's just do the
Yeah.
extreme and say that that you
Yeah,
die
but I get what you're
early.
saying. Yeah,
Yeah,
if
you
you're
die
gonna die
too
before your
early.
spouse, you
Yep.
don't want to be that person. Yeah.
Right, exactly. And let's say, or third is you both live a long time, right?
There you
Yeah,
go.
and
Yep.
and so if that's the case, then I would have loved to have the single life payout only, right?
Yep.
Or and the fourth is both die early, in
Yeah.
which case I
Yeah.
didn't get much of
Good.
my pension, and quite frankly, neither did my kids, right? They got
Yep.
nothing from this.
Yeah.
And so three out of the four options here, I wish I could choose the higher payout. One of
Yep.
the options I'm guarding against that, right? And so what people did in the old days, and they can still do today, is they can buy a life insurance policy to protect against number two. But then if I get one, three, or four, everybody else wins, right? And so what we want to think about is how can I do this with my own portfolios, right? This was done oftentimes when you left a company. And so the idea is that we can now have the ability to choose different payouts when
Yep.
I get to retirement. So this chart's a little cryptic. I just kind of pulled it in. This BS is a balance sheet only approach, right? It's the BS approach where we use that 3.5% withdrawal rate. But let's assume I wanted $100,000 of income a year, right?
Yep.
And so what would be the asset base that's required? Well, that'd be
That's
about
good.
2.8 million. Okay. Now these next two, AS stands for Actuarial Science. So these are different kinds of annuities. One's a fixed index annuity with a joint survivorship. The other one is a joint single premium immediate annuity. Some of these nuances, we could talk about later, but what I want you to see is that they pay out better than the safe withdrawal rate rule, and therefore they require fewer assets,
Less
don't
money.
they?
Yep.
And at the top of this is that single payout option, and it may even be higher today with interest rates going up, where I can get this 7% guaranteed distribution for as long as I live. And look at how many assets it takes to satisfy that, almost half, right?
Yeah.
And so the idea is that for people who are conservative, we can go to the insurance company and get an income stream for as long as I live that is significantly better than what the market's maybe approach is. And what I want people to really understand is the big knock on the annuities is they feel like they've lost their money, right? And there's no doubt that if I choose this top one, I did give 1.4 million to the insurance company, but here's something that's really important to understand. This 2.8 million is always accessible, but it's not really available.
Yeah. It's
Because
good.
if I take any money out of this account, by definition, my income goes down, doesn't it?
Yeah.
There's no room here for charity giving. There's no room here for gifts to children. All this money is required to satisfy this $100,000. Now, if I gave 1.4 million to the insurance company, I have 1.4 million left over with no income responsibility. So here we learn a lesson of what we call true liquidity, which is dollars that are available that are not required to produce income. That 1.4 million can give me more lifestyle. It could be
Yep.
charitable endeavors. It could be used for long-term care. I have a lot of money left over. With this 2.8 million, I can't really touch it.
Yep.
And
And
so part of the pension 2.0 as a final statement is if I do choose this top line, then I will purchase a life insurance policy equal to the amount of money that I put
yep.
into that annuity, so that if I die the next day, all the money is refunded
Yep.
to my spouse. Or if I get what I want and live a long time, all the money can go to my children. But what I love about this solution is it's very elegant in giving me the best distribution and the best legacy potential out of all of them.
What I love about options is it gives you a lot of options. What we're seeing down on the BS strategy is it almost takes $3 million and about a half of that portfolio would potentially produce the same amount of income. Now, you did talk about a potential risk. You could take all your money in a 7% annuity. This is not investment advice, not retirement advice. It's just an example, and you could die the next day and that would be problematic. And so what you're saying is getting a death benefit, getting a permanent life insurance policy that says, I'm going to make sure that if something, God forbid, happens, I'm going to be able to replace my assets. And what's interesting is we talk a lot about cash value on the show. We talk a lot about, like, a lot of people understand the power of life insurance designs. There's a world where you do this strategy and you're just optimizing for permanent death benefit versus cash value. That's why we should always play devil's advocate, because you could say one strategy is better than the other, but this, you need the death benefit for it to cover or optimize this solution. And so that's where talking with the specialist, talking to someone that understands what's going on is really important. And that's why you can't say one strategy is a one size fits all. The cool thing is, if you had $3 million and you had lots of cash value and you did overfund and you had enough death benefit to cover, now you have that cash value that can ultimately be utilized for other moves as well. So you can look at this as in multiple different scenarios. And the cool thing about what we teach our clients is, if you have a life insurance policy now or in the future, you have this option, whereas people that might not have insurability don't have this option. And so I'm just kind of going off here because I think we say a lot of these words, but you were able to share in a presentation form, which I'm very grateful for, a way that this makes sense. And I want you all to know this is just a fraction of what's in the book. If you are a financial advisor, if you're a specialist that helps your clients with this, or if you're someone that's like, I want to learn more, you got a book, and I would highly encourage people to go get it, because you just pack this with massive information and value. And I just want to thank you for that.
It's my pleasure. And the good news also is that there's a lot of mix and match, right? You don't have to have necessarily one way of doing it. So you might be volatility buffering for a while, then you move into a pension 2.0 because you're a little bit older. So there's a lot of combinations that can work. But one of the key things is, without a life insurance policy, you don't get any of them, right? You really don't get any of those choices, and you're stuck with kind of the default plan, which was what we started with, the Copernicus idea, which was, we're stuck with this, kind of conventional wisdom that works, in reality is we can do better than that.
My question is, since the book's been out, how has the response been? Because you have Dr. Wade Fowle, who literally teaches a certification on retirement income, like pretty high. I believe like anyone that has a CFP would acknowledge that Dr. Wade Fowle knows what he's talking about. A lot of people. So are people coming around? And is it just the people like Dave Ramsey out there and other like financial people on TikTok that are saying this stuff? Or do you still see a lot of people that are like financial advisors that still will say the talking points, annuities are dumb, life insurance is dumb? And
it's a slog. It's a slog,
okay.
Caleb. And that's why I use that example of, it took 100 years for us all to agree that the earth revolved around the sun. Dr. Wade Fowle he's been on a mission also to teach this. And it's, people with their own biases, or maybe even the way they get paid, or what their firm can or can't even offer, will stick to some of these things. I've had the pleasure of meeting him a number of times, and I actually work with, or good friends with, his real life insurance agent that really kind of brought all this to life. And the book really does model the retirement income certified professional designation, which goes through a safe withdrawal, a buffering strategy, a bucket strategy, and then a pension, or what they call flooring strategy, where you have an income for life, right? And so what I try to do is just bring all of those choices to the forefront so that you can see the pros and cons of each one, because you can get any of them can work. But even if I have some of the clients I have that have millions and millions, love the efficiency of income they get, because that means they have more money for charitable philanthropy, legacy, right? They're not consuming as much of their own asset base for their own income. And so, but it is a little bit of exercise in math, right? You have to be comfortable working through math. And then people have to be able to open up their minds to new ways of thinking, and just be grateful that the sun doesn't revolve around the earth, right? We got to understand that there's a new paradigm in town, plenty of academic research and evidence for it. And I do think that, these kind of conversations, Caleb, you're doing such a great job with your channel, really help bring these conversations to the forefront and really get them exposed like they need to be.
Yeah, I think more options, the better. Even if you don't want to do it, maybe you want to stick with the safe withdrawal rate. Awesome. Wouldn't it be cool to at least have the option to have another option? I'm saying that a lot, but like I think there's power in that. So it's like, what is the value of that? And it's like, if I could get a $500,000 portfolio to work just as hard as a 1 million, and I happen to have $1 million, why in the world would I want to tie up $1 a million just because I want it. Like, it
Right.
just doesn't make any
Yeah.
sense.
Yeah.
And then the last thing I'll say is there's a lot of people that follow us that are all about, and it's not investment advice, but they'll do like alternative investments and do real estate for cash
Hmm.
flow. And the
Hmm.
math is the math. The big difference between what you're talking about and what they're talking about is just risk. And you
Hmm.
don't tell me that real estate doesn't have risk. Don't tell me that your alternative investment that's like, no, like there's risk tied to it. And there's risk in insurance companies,
Hmm.
but these insurance companies are the most stable and will be the last institutions to fall. So you
Hmm.
might ask yourself, like, okay, could I do this with X, Y, and Z? And it's like, yes, but it's only as good as the promises. And the beautiful thing about insurance companies is they have a lot of track record and credibility. And so their promise and
Hmm.
guarantee far more important or valuable than even the most solid alternative investment. And so I'm not saying don't do certain things. That's not what I'm saying. I'm saying understand that risk needs to be factored into anything that you do. And just remember that, because I know people personally that sometimes forget the risk aspect, and
Hmm.
it really turns around and bites them in the butt.
Yeah, I call that financial amnesia. Like we all forget the markets drop until they drop. Right?
Yeah.
Then we remember. So yeah, I think everyone's looking for that kind of predictable income, whether they want to admit it or
Yep.
not. Real estate is a form of a pension, right? They're trying to get that predictable income. Dividend portfolios is a way of trying to get that predictable income. Just one will give us some guarantees behind it based on the,
Yep.
the, the claims paying power. Is what makes the difference.
I got one more question for you, and then I think we could jam a lot more. I know you talk about rates of return, and we
Right?
could jam about that if you'd like. Maybe that could be like part two.
Yeah.
But my question for you is whole life versus IUL.
Oh
Lots of
boy.
our friends do both, and there's lots of opinions out there from someone who's written this book, who's out there. What is your thoughts on just that whole life IUL conversation?
Well, first, I'll kind of straddle the middle and say anybody with permanent policy of any kind, I'm excited that you actually have it, right? That's better than having nothing. I come from the whole life background because of the guarantees built into it and just kind of that whole flavor. I think the one issue with IUL that I have is that it comes with its own sequence of return risk if we're not careful, right? So the IUL is assuming that it's going to earn a 6% return every single year. And every time it doesn't, it has to make up for it in order to stay on course. And that's okay while we're accumulating in that policy. But I think the risk is that when we start taking money out of the policy, if we don't hit the cap that we need or hit the guarantee or the rate that we're projecting, then it has to earn more the next year on top of the withdrawal rate to be able to keep that income, that income projection going the same way. So it just has to be managed a
Yeah.
lot more. And I think that sometimes it's just easier to take a non-correlated asset that can't go down
Yeah.
to be the supporting tool behind the assets that have the risk. And then the last thing, and I know you've had Bobby Samuelson on this, and I'm part of the Forum 400 where he speaks frequently. He's just worried about cap rates and the option pricing that go with them. And we'll see if that comes to fruition or not. But we know that there's just a lot more moving parts to it, and so I just appreciate having something in my portfolio that I don't have to worry about. And
Yeah.
if I'm going to use that as some of these strategies, I'd rather have an anchor to it than
Yeah.
also have some market exposure that may or
Yeah.
may not go forward.
Hear me out here. So if you're looking at life insurance as an investment, I could totally see where people want to do IULs. Like
Mm-hmm.
that you get the maybe a more upside, more flexibility and all. And I totally see it. But the moment we start talking about all your talking points about the fifth option, about future, what we're literally talking about avoiding risk and giving yourself options. It seems to me like it goes out the window the moment you create a contract that should work, but not 100% of the time. And I had this conversation with Todd Langford. He talks about like when the technical definition of permanent, it might be able to check the box. But when we hear permanent or when a consumer hears permanent, you don't think of it potentially being not permanent.
Correct. Yeah.
And it's just like the last thing I would want to do is build a foundation with a 5% chance that it may not work out, because everything else that I'm built is predicated on the foundation. And so that's what I'll say is like, if you're looking at this as an investment and you know your stuff and you're working with someone that understands, I'm not saying an IUL could have way more cash value than whole life. And
Mm-hmm.
I'm not one of these deniers of like it's going to get worse. Like I believe it, and I'm not anti IUL. But if you're going to use these talking points, and if you're going to look at this holistically, I think there's a reason why sometimes we're stuck in the old ages and like whole life, and it's just like, yeah, it looks good now, but 20 years from now, it's hard to know what's going to happen. And I love the fact that these insurance companies are creating some type of promises so that I can use the volatility buffer while I'm accumulating, do my thing, knowing that I have a fifth option for the future. I don't know if you've ever heard that articulated, but I just like those are some of the things that I think about.
Yeah, I
And I
think that's
feel
well
like
said.
they're making the same argument about rate of return and net
Yeah.
worth and BS, the
Mm-hmm.
balance sheet,
Mm-hmm.
and they're not necessarily taking the distribution. I feel like IULs also get sketchier and sketchier when you start doing income because you're taking longevity and you're creating unknown. And so I know I'm going on a mini rant, but those are my 2 cents.
I think it's well said. IUL certainly has its place, but not when it's the supporting tool
Right.
to already volatile places, right? I think at that point we would revert to whole life.
Yeah. And there's a world where if you're doing the bucket strategy, you could use an IUL as a part of
Yeah,
the
that's
bucket
right.
strategy.
That's
So I
right.
think it's like there's the devil's advocate. I think
Mm-hmm.
you just make sure that you have a quote unquote plan. And there might be a world where instead of having as big equity exposure, you have some of that being IUL, some of being whole life. Do your thing. But
That's right.
you want to now talk about the rate of return and the three types. And
Yeah.
just so you all know, we might be cutting this into two. We might be cutting this into two. So subscribe for the next episode or the next video. And I just also want to give this a shout out. Go get this book. Go get this book. If you feel like this was valuable and could help your career, or this is valuable and could literally make a difference in your financial life, I would encourage you to go. We'll have a link down below. Go get this book. And it would mean the world to me if you enjoy our show is to get this book and support Walter and what he's doing.
I appreciate that. Yeah. Yeah. So I'm working on this new concept, which is the three most important rates in retirement. And the first rate is the rate of return, right? The rate of return that we really focus on how much of my assets growing. It's the conversation that every advisor has. I kind of dub it my big brother can beat up your big brother. Like my portfolio is better than your portfolio. We're always fighting about the rate of return on something, and whether we actually use the right rates of return, or, is all that part of that conversation. But that's the basis for most of retirement planning. But as we move up the importance in rates, I would argue the rate of return is important, but we have zero control over that rate of return, really. It's going to be market based. The next rate that's important, I think, is the rate of withdrawal. And we saw a lot of evidence today that that is the limiting factor, right? If we think about a barrel of money, it is the spigot. If I have a big spigot, I get to enjoy a lot more money. If I have a small spigot, it's going to be a trickle, right? And I have to take certain steps and strategies to make sure I have the big spigot on my bucket
Yep.
instead of the small one. The 4% rule is the small spigot. The 7% SPIA is the big spigot, right? But I have to take certain steps.
Yep.
If I do a good job with my rate of withdrawal, then I get to the third rate, which I really care about, which is the rate of enjoyment, right? Which is overall of the work I've done in my savings and all the work I've done in life, how much enjoyment do I get out of my asset base? If I'm always focused on rate of return, I miss the ability to escalate and get myself out of the gnashing teeth of the safe withdrawal rate and volatility. The minute I can take steps to get rid of or eliminate myself from that safe withdrawal rate strategy, I move up into higher distributions,
Yep.
which gives me ultimate rate of enjoyment, right? And so I think that's really kind of this new new concept that I'm working on. Maybe it'll be a new book. Who knows? When I get done with it.
I think it's great, and it's just another perspective. And if you want to flesh out that idea more, or when you come out with your book, know that I would love to have you back on to to share more about this. But I do think it's a lot of times rate of return is the thing that we measure, so that's the thing that we talk about. But there's other things that move the needle in our own life. Any other thing that you would like to talk about before we wrap this up?
I don't think so. We talked about it a lot today.
Amazing. Question I always end the show with is, if this was your last day on earth and you were with the people that you love the most and you couldn't give them your book, you couldn't give them this presentation, what would you share and why?
Well, I'm another strategy. Another thing I'm looking at is linking this Japanese philosophy called ikigai, which you may have heard. And ikigai is the ability to do what you love, do what the world needs, do what you can get paid for, and what you're good at, right? And in the circle there is ikigai. And if you can find that, you'll never work a day in your life. And so I know we all struggle from time to time to find the right balances, but I know I'm in my ikigai because, I would do this for free because I love educating people about some of the challenges that we face in our financial lives. And so, I try to get my kids and people to think about those four things so that when you operate there, you're excited to wake up every day.
Walter, I appreciate your time, and I think it's so telling that you shared that answer, because in a way we're talking about the fifth option, and there's so many people that hate their working life and they want to retire, but it's really cool that in the midst of you're helping people be more efficient in this thing called retirement. And I think you and I would both not subscribe to the way that the world talks about retirement. And regardless if you love what you're doing or not, you should be efficient. Like I'm learning this stuff and I'm excited to be efficient. But I love what we're doing, and I don't plan on ever being taken out of service, but I want to have options, and I don't want to wait till 65 for those options. And so I think what's really cool is the principles and the conversations that we talk today are helping me live a richer life today. And I think that's powerful, is give yourself options, live your one life well. And that's how we'll end this. That's how we'll end the show.
Fantastic. It's been a pleasure.
80% of people that watch our YouTube videos are not subscribed to the channel. So it would mean the world if you've gotten any value from our show or channel to subscribe and leave a comment and share your biggest takeaway. It helps other people find our channel.